Welcome to Dual Edge Research, different markets, one research philosophy. We believe successful investing isn't about predicting the future. It's about consistently identifying higher probability opportunities through objective, data-driven research. That philosophy drives everything that we do. Whether we're analyzing thousands of stocks or hundreds of thousands of commodity spread combinations, the process is always the same. Filter, rank, select, execute, repeat. That research powers two specialized newsletters. The Bull Strangle newsletter applies the research process to stocks and options, identifying high-quality companies for systematic option income. The Smart Spreads newsletter applies the same discipline methodology to seasonal commodity future spreads. Through research into seasonality, historical performance, forward curves, and trade selection, our goal is simple. Identify higher probability opportunities backed by objective historical data. Today we're focusing on smart spreads. Let's begin. Over the past 3 videos, we've looked at several important decisions involved in building a higher probability commodity spread. We started by asking whether history favored buying or selling. Then we explored when seasonal opportunities have historically performed best. Finally, we looked at why selecting the right front month can dramatically influence long-term results. Today, we examine another key question: what spread structure has historically worked best? Should you trade a traditional 2-leg calendar spread, or can adding a third contract actually improve historical performance? At first glance, a 3-leg spread looks more complicated, but in reality, it creates an entirely different market exposure. A 2-leg spread measures the relationship between 2 delivery months. A 3-leg spread introduces an additional contract that changes how the spread responds to seasonal forces, supply and demand imbalances, and movement along the forward curve. In other words, you're not simply adding another contract, you may be creating a fundamentally different trade. Rather than assuming one structure was better, we tested both 2-leg and 3-leg spreads across thousands of historical trades. For every market, direction, and contract cycle, we asked the same question: which structure has historically produced the strongest combination of return, consistency, and downside protection? The answer wasn't universal. Some markets clearly favored 2-leg spreads, others consistently favored 3-leg structures. That's why the historical data, not conventional wisdom, should drive the decision. In many markets, 3-leg spreads delivered several meaningful advantages. They often produced higher average returns, higher win rates, and fewer large losing trades, and more consistent performance over time. Why? The third leg can reduce exposure to broad movements across the forward curve while placing greater emphasis on the seasonal relationships between specific delivery months. The result is often a smoother historical equity curve and improved risk-adjusted performance. Leg structure is another filter in the smart spreads methodology. Direction tells us whether buying or selling has historically offered the stronger edge. Entry timing tells us when that edge has been the strongest. Front month analysis identifies the best contract month. And now, leg structure helps determine whether 2 legs or 3 legs have historically produced the better trade. Each layer removes lower quality candidates and increases confidence in the remaining opportunities. By now, you've probably noticed a pattern. Every article in this series answers one important research question. Each one narrows the field before a trade ever reaches the watch list. In the next video, we'll move beyond historical research and examine today's market. We'll explain how forward curve analysis helps determine whether current market conditions support the historical edge, making it one of the final filters before a trade earns a place on the Smart Spreads watch list. Thanks for watching. If you enjoyed this video, visit bullstrangle.com for additional research, education, and the Smart Spreads newsletter. For a deeper dive into commodity spread trading, be sure to check out my book, Trading Commodity Spreads, which is available on Amazon. We'll see you in the next video.